All right, let's dive right into this. Welcome to today's Explainer, where we're breaking down a massive structural shift that's currently underway in the AI market. But hey, before we get into the weeds of this analysis, I want to be incredibly clear right up front. This Explainer is strictly for educational and analytical purposes. It's definitely not financial advice, okay? We're just here to look objectively at the data and recent market signals to understand exactly where things are heading.
So, the big question floating around right now, is the AI trade actually over? Look, for the past 18 months or so, the strategy was, well, remarkably simple. You bought broad AI infrastructure stocks, and you generally saw significant returns. But the market is definitely changing. Analysts are noting that the easy money phase, buying literally any stock just because it slapped AI on its pitch deck, is effectively coming to an end.
And that brings us to what's being called the Great Re-rating. The market is no longer just rewarding pure potential or a cool concept. Now it's demanding actual execution, real distribution, and, most importantly, profitability. The era of easy money is officially giving way to the era of fundamentals.
The primary signal for this major shift actually emerged in Google's Q1 earnings report, where they posted a staggering $9.57 billion in cloud revenue. Analysts really view this as the exact moment the narrative flipped. It showed that a major player could leverage AI services to drive some very real, very significant top-line results.
And to put that into perspective, that $9.57 billion represents a 28% year-over-year growth rate. That is a massive data point. It proves to the broader market that AI services are actively accelerating real enterprise demand today. It's not just acting as some speculative placeholder for a future that might never happen.
So, here is the absolutely crucial point. Google Cloud achieved its first full year of profitability in Q1. This clearly demonstrated to investors that high-intensity capital expenditures in AI, all those expensive chips and data centers, can, in fact, translate into actual bottom-line returns.
Now, right about here is where a skeptical analyst might jump in and raise a pretty fair question. They'd probably say, wait a second, doesn't Google just have an inherent scale advantage that literally no one else can match?
And you know what? That's a completely valid pushback. Scale absolutely is their advantage. But successfully monetizing that massive scale, specifically through AI, that's an entirely different challenge. With over 2 billion active Android users, Google is proving they can actually capture tangible value by casting this incredibly wide distribution net.
Combine that Android base with over 3 billion YouTube users. Pushing their Gemini AI model through these massively established channels sends a very clear message to the rest of the sector. Just having a superior underlying model? That's no longer enough. The new baseline requires a proven path to profitable distribution.
So, with the bar effectively raised by Google, the market's focus naturally shifts down the AI stack to two other critical layers reporting earnings this week. We're looking at Palantir on the software side and Arista Networks for the hardware and networking side. Starting with Palantir, analysts are going to be tracking the adoption of their artificial intelligence platform, or AIP, extremely closely. This is really acting as a litmus test for the whole industry. Are large enterprises actively buying AI software to solve their complex daily problems, or are they still just kind of stuck testing things out in the pilot phase? Then we have Arista Networks, which represents the high-speed networking layer that is absolutely essential to connect all these AI chips together. Their guidance on 400G and 800G networking speeds acts as a direct, real-time gauge of just how intense these ongoing data center buildouts actually are. What analysts are doing right now is cautiously weighing these two distinct layers against each other. By comparing Palantir's software adoption metrics against Arista's forward-looking hardware guidance, we can really assess the overall balance of the ecosystem. Essentially, we need to know, is software demand actually keeping pace with all this rapid physical hardware investment?
But keep in mind, not all of our crucial signals come strictly from public equities. And that brings us to CoreWeave. They are a private, top-tier NVIDIA cloud partner. Because they provide GPU cloud services directly to users, they act as a vital health indicator for the broader private AI market. Since CoreWeave is a private company, we have to look for signals in the news surrounding their fundraising rounds, their valuation shifts, or any new enterprise partnerships. That gives us a really direct read on the underlying compute demand from the thousands of AI startups out there that, frankly, simply cannot afford to build their own massive data centers. Now, looking neutrally at the risks involved here, because we always have to weigh both sides, market analysts are noting that any sudden slowdown in capital expenditure by the major cloud giants could easily trigger a broader sector correction. If enterprise adoption stalls out at the software level, well, then the entire hardware build-out narrative could really be called into question.
There's also a significant concentration risk to consider. Right now, the market is pricing in this underlying assumption that a few primary platforms are going to capture the vast majority of the value. In a phase like this, where execution absolutely must outpace hype, second-tier players that fail to show a clear return on investment might see their valuations sharply and painfully re-rated.
Which brings up another great moment for our skeptical analysts to interject. Okay, the market dynamics are clear, but what is the practical takeaway for a day-to-day business operator right now, outside of just public market investing?
Well, the operational playbook here requires shifting away from viewing AI as just one big monolith. Instead, operators need to be tracking demand across three very distinct layers of the value chain. You have your foundational infrastructure, the networking that connects it, and finally, the end-user applications.
Analysts emphasize that recognizing this divergence is absolutely key. Capital is no longer just a rising tide floating all boats. It is flowing very selectively to companies that are demonstrating measurable, real-world business adoption, and it's leaving the more generic AI indices lagging behind.
So, to summarize what we're seeing, the AI sector is officially moving well beyond the initial picks and shovels phase. While having best-in-class infrastructure obviously remains vital, the market is now weighing profitable distribution and flawless execution just as heavily.
Which leaves us with this final provocative thought based on everything we've covered today. As capital continues to concentrate at the very top, we really have to ask ourselves, is this the healthy maturation of an industry that's finally demanding real value? Or is it the beginning of a harsh correction for companies that simply cannot execute? It's something to think about. Thanks so much for joining me on this explainer. Keep your eyes on the data, and we'll see you next time.